Welcome to the deep dive. Today, we're setting the bar high. We're not just talking about passing the safe exam. Nope, we're aiming for that perfect score, that 100 out of 100.
Exactly. And as your NMLS trainers, we know that means drilling down into the really tough stuff.
That's right. So today, our mission is laser focused. We're diving deep, really deep, into one of the most heavily tested regulations out there, the Truth in Lending Act. You probably know it as TILA.
hmm And this isn't just a surface skim. This deep dive is specifically for you, the ambitious learner who's chasing that perfect score. We're pulling from specialized materials, focusing right in on TILA's mortgage disclosures and all those crucial consumer protections.
Yeah, our goal today is to unpack every single critical detail. We want to highlight every nuance, every little tricky part, and make absolutely sure you memorize the precise information you need to just completely dominate the TILA section on exam day.
We're going to be thorough, definitely technical, and really zeroed in on those small but vital details, the ones that make the difference between just passing and getting that flawless score.
Okay, so what can you expect from this deep dive? Well, we're starting with TILA's core purpose, the why behind it all.
Right. Then we'll navigate through its complex web of timelines and those record retention rules. Big area for exam questions, that one.
Huge. Then we'll dissect the key consumer protections, like the right of rescission, your cooling off period, and how advertising gets regulated.
And finally, we'll demystify those special loan categories, high cost and higher price mortgages. We'll look at the triggers, the requirements, all of it.
Every single piece of information we're sharing today is designed to stick, to directly answer potential exam questions and give you that edge. So get ready to absorb. This is your shortcut to mastering TILA for that perfect score.
Let's do it.
All right, let's lay the groundwork. Before we jump into the weeds with specific numbers and dates, which you absolutely will need to memorize, let's get the big picture of TILA. What's its main purpose? Why was it even created? This isn't just background fluff. It often forms the basis of conceptual questions on the exam.
That's a great place to start. TILA wasn't just created out of thin air. It actually goes back to 1968. And it was enacted as Title I of a much broader act, the Consumer Credit Protection Act, or CCPA.
Okay, CCPA. Got it.
And the rules that actually implement TILA, the ones you'll deal with constantly, that's Regulation Z. So TILA, Regulation Z, they go hand in hand.
Red Z.
Understand the core goal here is fundamental, especially for nailing those perfect score points. And there's a really handy framework. We call it the CAR framework. This is something you'll want to lock in right away.
Yeah.
The primary goals of TILA.
CAR. Okay, what does that stand for?
So the C is for cost of credit disclosure. Think about how confusing it must have been before TILA. Lenders could present loan costs on all sorts of ways, making it almost impossible to compare offers fairly.
Yeah, like comparing apples and oranges.
Exactly. So TILA stepped in to protect consumers by requiring clear disclosure of the true costs in terms of credit. And just as importantly, it created uniform standards for how these costs are stated. It's all about transparency. So you, the borrower, can make informed choices.
Makes sense. Disclosure first. What's A?
The A stands for advertising regulation. TILA makes sure that credit advertising is truthful and, crucially, not misleading. Before this, you could have ads screaming low payments but hiding killer fees in the tiny print.
Bait and switch, basically.
Precisely. TILA says if you advertise a term, it has to be a term you actually offer, and the ad needs enough information so it doesn't mislead anyone. It keeps the marketplace more honest.
Okay, C for cost, A for advertising. What's R?
And R is for the right of rescission. This is a really powerful tool for consumers. It gives you a legal right to basically cancel or rescind certain types of mortgage transactions within a specific time frame.
It's like a cooling off period.
Exactly like a cooling off period. It gives borrowers a chance to step back and reconsider, even after they've signed the papers. We'll definitely dig into the specifics of rescission later. It's a very heavily tested area.
So CAR, cost disclosure, advertising rules, and the right of rescission. Fundamentally, it sounds like it's all about transparency and giving consumers the information and power they need to make smart choices. Feels like a consumer empowerment law.
That's the heart of it. Now, moving on from purpose, here's another detail that's subtle but super important for your exam, a place where you can easily lose points if you're not careful. Who does TILA actually protect? And just as important, who does it not protect?
The scope question. Always tricky.
It really is. So TILA applies to credit offered to consumers, but only when it's primarily for personal, family, or household purposes. The reason for the credit matters.
Okay, so not for business loans.
Right. And it's triggered when credit is offered regularly by a creditor. meaning they're in the business of extending credit, not just doing a one-off loan to a friend. And the credit either have to include finance charge or be payable in more than 4 installments.
Yeah.
If it meets those conditions, TILA kicks in.
Personal use, regularly offered, finance charge, or more than 4 payments.
I'll cut it.
But here's the part you absolutely need to memorize for that perfect score, the exclusions. TILA does not apply to these specific categories. Get ready to flag these in your notes. First, credit for business, commercial, or agricultural purposes. If it's for a company, a farm, an investment property, TILA doesn't cover it. Those have different rules.
Okay, business out.
Second, public utility credit. Think your electric bill, your water bill. Those aren't covered by TILA.
Right. Utilities are different.
And third, student loans guaranteed by the federal government. Again, these fall under their own specific, complex regulations. Business, public utilities, federal student loans, that's a classic exam distinction right there, knowing the boundaries of the rule, who's in and who's out. Super important for precision.
Absolutely vital.
Okay, speaking of precision, here's where things get, well, really interesting and honestly, a point that trips up so many people aiming for 100-100. It's the definition of a business day. It's not always the same under Red Z, is it?
You nailed it. This detail is absolutely critical for your perfect score. Seriously, Regulation Z has 2 distinct definitions for business day, and if you mix them up on the exam, especially on calculation questions, you will lose points. It's a common trap.
2 definitions. Okay, let's break them down.
First, there's the general definition. This means any day the creditor's offices are open to the public for carrying out substantially all their main business functions.
So basically, days the bank is open and doing real work.
Pretty much. Think days the bank is open for business. If they're open Monday to Friday, those count. If they happen to be fully operational on a Saturday, taking applications, processing funding, then Saturday could count under this definition too.
Okay, that makes sense. And when does this general definition apply?
Okay, here's a key memorization point. This general definition applies specifically to the loan estimate LE timeline. When you're counting the 3 days to get that LE out, you use this definition days the creditor is actually open and operating.
LE timeline with general definition. Got it.
What's the other one? The other one is the more specific definition, and this one's actually simpler to apply. It means all calendar days except Sundays and legal public holidays.
All calendar days except Sunday and holidays. So Saturday always counts here.
Exactly. Saturday always counts under this specific definition, whether the bank branch is physically open or not. This is super important for calculations. Now, commit this to memory. This specific definition applies to the closing disclosure CD delivery timeline and also to rescission periods.
CD and rescission use the specific definition where Saturday counts.
Wow, okay.
Yeah. So if you get your CD on a Thursday, the 3 business days are Friday, Saturday, Monday. The earliest you could close is Tuesday, assuming Monday isn't a legal holiday. If you get it Friday, it's Saturday, Monday, Tuesday. Earliest closes Wednesday. You have to know which definition applies to which situation.
Definitely a common trick question waiting to happen.
Yeah.
The type of document dictates the definition. Don't mix them up. That's a perfect score point right there.
Couldn't have said it better myself. Now, staying on definitions, let's decode 2 more core concepts. The finance charge and the annual percentage rate, or APR. You need crystal clarity on these for the exam.
All right, finance charge first. What exactly is included?
The finance charge is the total cost of consumer credit expressed as a dollar amount. It's not just the interest, it's the overall price tag in dollars for getting the loan.
Okay, the total dollar cost. Right. It includes things like interest, naturally, but also other charges paid directly or indirectly by the consumer. And this is important. It includes fees paid to third parties if the creditor requires the use of that specific third party.
Ah, so if the lender says you must use this appraiser, that appraisal fee goes into the finance charge.
Potentially, yes, especially if the fee seems inflated or the requirement itself adds cost. But here's a detail you absolutely need to lock in for the exam. Mortgage brokers' fees are always included in the finance charge. Always. That's a non-negotiable, often tested point.
Mortgage broker fee is always in the finance charge.
Got it.
What's usually not included?
Generally, it excludes things like bona fide and reasonable fees for services in real estate transactions, like standard title examination fees, appraisal fees when you can choose the appraiser or the fee is reasonable, credit report fees, things like that. But remember that broker fee exception.
Okay, so it's about capturing the full real dollar cost the borrower pays specifically to get that loan, beyond just the interest, the actual hit to the wallet.
Precisely. And that leads us perfectly into the annual percentage rate, or APR. While the finance charge is a dollar amount, The APR is the cost of credit expressed as a yearly rate, like a percentage.
So it's the rate version of the total cost.
Exactly. It takes the nominal interest rate and then folds in many of those other costs from the finance charge, things like points, broker fees, private mortgage insurance, PMI, origination fees, underwriting fees, and expresses that total cost as an annualized rate.
Why is that so important?
Because it provides a standardized way for you, the consumer, to compare different loan offers. Lender A might offer a lower interest rate but higher fees, while lender B has a slightly higher rate but lower fees. The APR helps you see the true overall yearly cost of each loan, making it much easier to compare them apples to apples.
Okay, so APR gives that more holistic view, the standardized comparison tool. Makes sense. That's definitely key for understanding loan offers.
Absolutely. Understanding the difference and the purpose of both finance charge and APR is fundamental for TILA and for your exam.
Okay, let's shift gears to timelines. As they say, time is money, and on the SAFE exam, knowing these precise TILA timelines is absolutely vital for your score. This section is packed with numbers, deadlines, waiting periods. It's prime territory for exam questions.
You're spot on. These timeframes are tested constantly, and like we just discussed, remembering which business day definition applies to each is crucial. Let's break them down based on when they typically occur in the loan process.
Sounds good. Where do we start?
Let's start right at the beginning. What needs to happen upon or within 3 business days of application?
Okay, 3 days from application, what's due?
First up, the big one, the loan estimate, LE. For most closed-end loans, think standard mortgages. Here's a key memorization point. The LE must be provided no later than 3 business days after the creditor gets a completed application.
3 business days for the LE, and that uses the
general definition of business day. Days the creditor's offices are open for substantially all business functions. Remember that distinction.
right, general definition for LE. What else in those first 3 days?
If the application is for an adjustable rate mortgage, or ARM, secured by the borrower's main home, you also have the CHARM booklet. That's the Consumer Handbook on Adjustable Rate Mortgages.
Ah, the RM-specific booklet.
Yep. And the timing you need to remember is the same. It's due no later than 3 business days after the consumer submits that ARM application. It's designed to explain how ARMs work, the risks involved, etc.
Okay, LE and CHARM booklet within 3 general business days.
Yeah.
Anything else early on?
Yes. For home equity plans, like ALAs, home equity lines of credit, these are open-end lines of credit. The rule here is a bit different. The required disclosures and the what you should know about home equity lines of credit brochure are due at the time an application is provided.
So immediately. If I'm sitting there applying, I get it right then.
Ideally, yes. But here is a crucial detail for the exam, a practical allowance. If the application is taken over the phone, the lender has within 3 business days to deliver or mail those HELOC disclosures.
Okay, so instant for in-person HELOC apps, but 3 days if it's over the phone. Good distinction to remember.
Definitely. Now, let's move on to the absolutely critical waiting periods before closing, or what the rule calls consummation. These are built-in pauses designed to make sure you have time to review the key documents before you're legally committed.
These sound important. What's the first one?
There's a 7 business day waiting period tied to the initial loan estimate. This is a major rule, frequently tested. A loan subject to TREAT IAD rules cannot be consummated. You can't close until 7 business days after that initial LE was provided or mailed.
7 business days after the LE is sent. That's a decent chunk of time.
It is. It guarantees a minimum review period. Now, here's a crucial detail for your perfect score, often an exam question. Can this 7-day wait ever be waived?
Probably only in emergencies.
Exactly. It can only be waived for a bona fide personal financial emergency. Think imminent foreclosure sale, something truly urgent and documented. It's a very high bar, not just for convenience. You need to know that specific exception.
Bona fide personal financial emergency. Got it. What's the next waiting period?
The 3 business day waiting period before closing, tied to the closing disclosure, CD. This is another one you absolutely must know. The final CD must be received by the consumer at least 3 business days before consummation.
3 business days before closing for the CD. And which business day definition does this use?
Ah, good catch. For this rule, it's the specific definition. All calendar days except Sundays and legal public holidays. Remember, Saturdays count here. This is vital for calculation questions on the exam. You need to be able to count these days correctly.
CD wait 3 specific business days. Saturdays count. Okay.
That's clear.
Very clear and very important.
Now, this next one is huge, I think. What happens if something significant changes after the initial CD is sent out, but before the closing happens? Do they just hand you a new CD at the table, or does it trigger a whole new waiting period? This feels like guaranteed exam territory. You are absolutely right. This is prime exam material and crucial for that perfect score. There are specific changes that are considered so significant that they do require a revised CD and trigger a brand new 3-business-day waiting period. It restarts the clock to ensure the borrower isn't ambushed by major changes at the last second.
Okay, what are those triggers? What forces a new 3-day wait?
There are 3 critical reasons you need to memorize. A new 3-business-day waiting period is triggered if a revised CD is issued before consummation because of one of these. 1. The APR becomes inaccurate. The annual percentage rate is such a key indicator of cost. If it changes by more than a specific tolerance, generally 1/18 of 1% for fixed-rate loans, or 1/14 of 1% for adjustable rate loans, that's a major change requiring a new wait period. The exam might just say inaccurate, so know that's the trigger.
Okay, APR changes significantly. What's number 2?
2. A change in the loan product. If you switch from, say, a fixed rate to an adjustable rate loan, or maybe from a conventional to an FHA loan, that's a fundamental shift in the loan itself. That requires a new CD and a new 3-day review.
Makes sense. Product switch equals new wait. And the third?
The third critical trigger you have to remember is the addition of a prepayment penalty. If a penalty for paying the loan off early wasn't on the initial CD but gets added later, that's a significant new term that restricts the borrower's future options. Adding it triggers the new 3-day wait.
APR inaccuracy, loan product change, adding a prepayment penalty. Those are the 3 big ones for a revised CD wait. Got it.
Exactly. Memorize those 3. Now, don't confuse that with the 4-business-day waiting period for a revised loan estimate. If the LE needs to be revised for a valid reason earlier in the process, like a change in circumstances but not one of those 3 CD triggers, that revised LE must be received by the consumer no later than 4 business days prior to consummation. It's a different document, different timeline.
4 business days before closing for a revised LE. Okay.
And one more specific waiting period to note, the 3-day HWIPA disclosure. For those high-cost mortgages we'll discuss soon, borrowers get special disclosures at least 3 business days before closing. It's an extra layer of protection for those riskier loans.
Wow, okay. Lots of numbers, lots of specific day counts, and 2 different definitions of business day. You really have to keep these straight for the exam.
You absolutely do. Precision is key here. Now, what about timelines after the closing, post-consummation?
Good question. What happens then?
Well, the most famous one is the right of rescission period. We mentioned it earlier. For certain loans, specifically refinances and HELOCs on your primary residence, the borrower gets a 3-business-day period to cancel the loan, even after closing.
The cooling off period again, how is that 3-day period calculated?
Okay, critical detail for calculations. The period begins the day after closing, and it ends at midnight of the 3rd business day. And here's that definition again for rescission purposes. A business day is all calendar days except Sundays and legal public holidays. The specific definition. Saturdays count. You will likely see calculation questions on this.
Day after closing, midnight on the 3rd specific business day. Saturdays count. Got it locked. What if the borrower actually rescinds?
If they rescind, the lender has obligations. Here's a number to remember. The lender has 20 calendar days after receiving the rescission notice to return any money or property the consumer paid in connection with the transaction. That includes fees, down payments, everything.
20 calendar days to return funds. Okay, any other post-closing timelines?
Yes, for post-consummation CD corrections. What if the lender realizes after closing that a fee was charged that exceeded the allowed tolerance levels? They have a way to fix it. Commit this to memory. To cure tolerance violations, the creditor must refund any excess charges and provide a corrected closing disclosure within 60 days after consummation.
60 days to refund tolerance cures and send a corrected CD.
Correct. And that 60-day window also applies to fixing non-numerical clerical errors on the CD, like a typo in an address. They have 60 days after closing to provide a corrected CD for those 2.
Okay, 60 days for corrections, refunds, and clerical fixes on the CD. Anything else?
One more specific one for ARMs, the ARM rate change disclosure. For adjustable rate mortgages secured by the borrower's principal home, when the interest rate is about to change in a way that results in a new payment amount, the lender has to provide a rate change disclosure. And the timing you need to know is at least 60, but no more than 120 days before that change takes effect.
60 to 120 days notice before an ARM payment change. That's a pretty wide window.
It is, but it ensures the borrower gets ample warning to budget for the new payment.
Okay, we've covered disclosures and waiting periods, but what about keeping records? How long do lenders have to hold on to all this paperwork? This feels like another area ripe for memorization questions on the exam.
Absolutely. Record retention is definitely tested. Knowing these specific timeframes is essential for compliance and, yes, for your exam score. These are straight facts to memorize.
All right, let's hear them.
Okay, get ready to jot these down. Key retention periods you must know. Closing disclosure, CD records, must be kept for at least 5 years after consummation. That's the longest one, reflecting its status as the final document.
5 years for the CD. Got it.
Loan estimate LE records must be kept for at least 3 years after consummation.
3 years for the LE. Okay.
Loan originator compensation records. These also need to be kept for at least 3 years, but it's measured from the date of each payment received by the originator. This helps track compliance with compensation rules.
3 years for LO comp records from date of payment. Makes sense.
Ability to repay, ATR compliance records. Evidence showing the lender complied with ATR rules must be kept for at least 3 years after consummation.
3 years for ATR proof.
And lastly, escrow closing notice and partial payment policy records. These need to be retained for at least 2 years.
2 years for escrow closing and partial payment policy docs. So 5 years for CD, 3 for LE, LO comp, ATR, and 2 for escrow partial pay. Seems like straightforward memorization is needed here.
That's exactly right. Put those on your flashcards. No way around just memorizing those durations. Let's dive deeper into one of those key consumer protections we mentioned, the right of rescission. This is a powerful legal tool under TILA. It essentially lets a borrower void the contract, putting both parties back to where they were before the loan happened.
So it's like hitting the undo button on the loan.
In essence, yes, for specific situations. Let's focus first on the standard 3 business day rescission. As we said, it's a cooling off period. Here's a point to really understand. It allows a borrower to cancel certain loans until midnight of the 3rd business day after the last of these 3 things happens. 1, consummation closing. 2, delivery of the required notice of the right to rescind, A&D 3. Delivery of all material disclosures like the accurate APR and finance charge.
So the clock doesn't even start until all 3 of those things have happened. Closing, getting the notice, and getting accurate key disclosures.
Correct. All 3 conditions must be met for that 3-day clock to begin ticking. Now, what kind of loans does this apply to? This is crucial. It applies to credit transactions, both open-end like HELOC and closed-end like refinances, but only when they are secured by the consumer's principal dwelling, your main home.
Refis and HELO close on your primary residence. Got it.
Yeah.
What doesn't it apply to? This feels like a critical distinction for the exam.
It is absolutely crucial. Commit this to memory, highlight it, whatever you need to do. The right of rescission does not apply to what TILA calls a residential mortgage transaction. And that term is specifically defined as a loan used to finance the purchase or the initial construction of a consumer's principal dwelling.
No rescission on purchase loans or new construction loans. Only on refinances or EHOLOs on the home you already own and live in. That's a huge distinction.
Huge. They love to test that exception. Now, regarding the process, the creditor has to provide 2 copies of the notice of right to rescind to each person who has an ownership interest in the property.
2 copies each. So if a married couple owns the home, they get 4 copies total.
Exactly. And another key rule during this 3-day period. The lender cannot disperse any loan funds except potentially into an escrow account. They can't give the money directly to the borrower or pay off the old loan until they're sure the borrower hasn't rescinded.
So the money stays put until the cooling off period is safely over. Makes sense.
Right. But what if the lender messes up? What if they don't provide the correct notice or the material disclosures are inaccurate?
Does the right just disappear?
No, quite the opposite. This leads to the 3-year rescission or the extended right. This is a major point for your perfect score. If the creditor fails to provide a compliant rescission notice or fails to provide accurate material disclosures like the APR or finance charge, that right to rescind can be extended for up to 3 years from consummation.
3 years. Wow. That means getting those notices and disclosures absolutely perfect isn't just good practice. It's legally essential to avoid having a loan potentially unwound years down the line. That's a massive consequence.
It's a huge incentive for lenders to get it right the first time. Now, shifting from rescission, let's talk about TILA's advertising rules. These are all about ensuring truth and transparency when lenders promote credit products.
Preventing those misleading ads we talked about earlier.
Exactly. The basic rule is, if an ad for credit includes specific terms, It must only state terms that the creditor actually offers or will arrange. No making up attractive terms that aren't real.
Seems straightforward. But you mentioned trigger terms earlier. What exactly is a trigger term in advertising, and why is it so important for the exam?
Good question. A trigger term is a specific piece of information in an ad that, if mentioned, triggers a requirement for the ad to include more comprehensive disclosures. It stops lenders from cherry-picking only the most attractive numbers without providing necessary context.
Okay, so if you say X, you also have to say Y and Z. What are the trigger terms for closed-end loans, like mortgages?
For closed-end loans, if an ad mentions any of these, it's a trigger term. The amount or percentage of a down payment, like only 3% down, the number of payments or the repayment period, like pay over 30 years, the specific payment amount, like payments under $1,500,
Yeah.
the finance charge, like low finance charge.
Down payment, number term of payments, payment amount, or finance charge, if any of those are in the ad.
Then the ad must also clearly and conspicuously disclose these additional items. This is a key memorization point. The amount or percentage of the down payment, even if it was the trigger. The terms of repayment, like the loan term, payment frequency, any balloon payment. And critically, the annual percentage rate, APR. You have to show the true comparative cost.
Got it. Mention a trigger term for a mortgage. You have to disclose down payment, repayment terms, and APR. What about for open-end plans, like ELOCs?
Similar concept for open-end loans, home equity plans. If an ad includes trigger terms, like the finance charge or specific payment terms, it generally triggers the requirement to disclose any loan fees, like application fees or annual fees, the periodic rate used to calculate the finance charge, and the maximum APR that might apply, especially if it's a variable rate plan.
Okay. And are there things ads absolutely cannot do?
Yes, TILA includes specific prohibitions to prevent deceptive practices. Ads are prohibited from misleadingly advertising fixed rates or payments without clearly stating how long that rate or payment is actually fixed for. You can't imply it's fixed for the whole loan if it's only fixed for, say, 5 years.
No fuzzy fixed claims.
Making misleading comparisons in ads, like comparing their loan unfairly to government loan programs or other products without full context.
Keep comparisons honest.
Misrepresenting government endorsements. Ads can't imply that a government agency endorses the lender or the specific loan product when it doesn't.
No fake government seals of approval. Makes sense. It really circles back to giving consumers the full, honest picture, not just a tempting but incomplete snapshot.
That's precisely the goal of TILA's advertising rules.
All right, let's tackle some more advanced TILA territory now. This is definitely material you need for those higher scores, maybe even that perfect score. We're talking about how TILA identifies and deals with potentially predatory loans through special categories like high cost and higher priced mortgages. These come with really strict rules.
You're absolutely right. These categories, HEPA and HPML, are critical parts of TILA, designed specifically to curb predatory lending. They have very specific numerical thresholds and extra requirements. You must know these numbers cold for your exam. They are frequently tested.
Okay, let's start with the first one. High cost mortgages, or HEPA.
Correct. High-cost mortgages fall under Section 32 of TILA, which is formally known as the Home Ownership and Equity Protection Act, HEPI. Think of HEPA as the big red flag. It provides significant extra protections for loans that have unusually high interest rates or high fees, identifying them as potentially risky or predatory.
So how does a loan get flagged as high cost? What are the triggers?
Knowing these thresholds is absolutely essential. Memorize these triggers. A loan secured by the borrower's principal dwelling becomes a high-cost mortgage if it meets any one of these tests. First, the APR threshold. This is a key number for your perfect score. The loan's APR exceeds the average prime offer rate, APR, which is a benchmark rate by more than 6.5 percentage points for a comparable first-line loan.
APR is 6.5 points over APR for a first mortgage. Wow, that's significantly higher than average.
It is. That's the point it flags it as unusually expensive. Second trigger, the points and fees threshold. This one has a dollar amount tied to it that adjusts periodically, so pay attention to the figure given in your exam prep materials or the question itself. As of early 2025, for a loan of $26,968 or more, if the total points and fees charged exceed 5% of the total loan amount, it's a sweeper loan.
Okay, loan over about $27K, fees over 5% of the loan amount, equal fee. What about smaller loans?
For loans less than that amount, like $26,968, the threshold is the lesser of 8% of the loan amount, or a specific dollar figure, around $1,300 currently. But the 5% for larger loans is the most commonly tested part. Just know the main threshold. 5% for loans, $26,968 or more.
Got it. 5% points and fees threshold. What's the third trigger?
The third is the prepayment penalty threshold. A loan can be classified as HEPA if it includes a prepayment penalty that's enforced for more than 36 months, that's 3 years, after consummation, or if the penalty amount exceeds 2% of the amount being prepaid.
A long or large prepayment penalty can make it HEPA.
Yes, but here's a crucial twist, a perfect score detail. While having such a penalty can trigger HOHEPA status, HEPA loans themselves are ultimately prohibited from having prepayment penalties at all.
Wait, so the penalty makes it HOPA, and then HOPA bans the penalty.
Exactly. It's a way of saying this penalty structure is indicative of a potentially predatory loan. Therefore, this loan gets HOPA protections, and one of those protections is you can't have that penalty. It's a clever mechanism.
That is clever. Okay, so if a loan hits one of those triggers, APR, fees, or prepayment penalty, it's HOPA. What special rules apply then? What are the protections?
Because these loans are considered high risk, there are significant prohibitions and requirements for HEPA loans. You absolutely need to know these for the exam. HEPA loans are generally prohibited from having balloon payments. This prevents a situation where the borrower makes smaller payments for years and then suddenly owes a massive lump sum. There are very limited exceptions. They cannot have negative amortization, where your loan balance actually goes up over time because your payments don't even cover the interest. That's banned. As we just discussed, they are prohibited from having prepayment penalties. Lenders cannot make a HEPA loan without properly verifying the borrower's ability to repay, ATR. They can't just issue the loan knowing the borrower likely can't afford it. And here's a huge one. Creditors are prohibited from making a high-cost loan without first receiving written certification that the borrower has obtained pre-loan counseling from a HUD-approved housing counselor. This ensures the borrower gets independent advice before taking on such a high-cost loan. Mandatory counseling for HOPO loans. That seems like a really important safeguard. Okay, so that's HOHEPA, the big red flag. How is that different from higher-priced mortgage loans?
Good question. Higher price mortgage loans, HPMLs, which fall under Section 35 of Regulation Z, are another category with extra protections, but they're distinct from HOPA. Think of them as being in a tier between standard loans and high-cost loans. They're more expensive than average, but not quite meeting those very high HOPA triggers. Their triggers are also tied to the APR versus the APR, but the thresholds are lower.
Lower thresholds than HOPA. Okay, what are the specific HPML triggers? These sound like more numbers to memorize.
They are. Precision is key here for your perfect score. An HPML is a closed-end loan secured by the borrower's principal dwelling where the APR exceeds the APR for a comparable transaction by 1.5 percentage points or more for a first lien conforming loan. Your standard meets Fannie Freddie guidelines type loan.
1.5 points over APR for conforming first liens.
2.5 percentage points or more for a first lien jumbo loan, loans exceeding conforming limits. 2.5 points over APR for jumbo first liens.
And 3.5 percentage points or more for a subordinate lien loan, like a second mortgage or a closed-end home equity loan.
3.5 points over APR for subordinate liens. Okay, 1.5, 2.5, 3.5, depending on the loan type. Got it. So if a loan hits one of these thresholds, what extra requirements kick in?
There are two main requirements for HPMLs that you need to know for the exam. First, escrow account. This is a big one. For most HPMLs, an escrow account for property taxes and homeowners insurance premiums must generally be established and maintained for at least 5 years.
Mandatory escrow for 5 years on HPMLs. That helps ensure taxes and insurance get paid.
Exactly. It protects both the borrower and the lender. The second requirement involves appraisals, specifically targeting potentially fraudulent property flipping.
Ah, the flipping rule. How does that work?
A second appraisal is required for an HPML if the property being purchased was recently acquired by the seller and is now being resold at a significantly higher price. This triggers under two specific conditions you need to memorize. Condition 1, the seller acquired the property within the last 90 days, and D, the price the borrower is paying exceeds the seller's acquisition price by more than 10%.
Within 90 days, price up more than 10%, need a second appraisal.
Condition 2, the seller acquired the property within the last 91 to 180 days, and D, the price the borrower is paying exceeds the seller's acquisition price by more than 20%.
91, 180 days, price up more than 20%. Also need a second appraisal. Okay, those specific time percentage combos are designed to catch those quick, potentially inflated flips.
Precisely. It adds an extra layer of valuation scrutiny to protect the borrower and the lender in those specific higher-risk HPML transactions. Knowing those 90-day 10% and 180-day 20% triggers is definitely perfect score territory.
Okay, let's try to pull a lot of this together now with TRIDE. That's the TILA-RESPA Integrated Disclosure Rule, right? This seems like it was a huge change, streamlining a lot of the disclosures we've been talking about. It feels absolutely central to modern lending and the SAFE exam.
You're absolutely right. TRIDE was a massive undertaking by the CFPB. It integrated the key disclosure requirements from both TILA and RESPA, the Real Estate Settlement Procedures Act, for most closed-end mortgage transactions into just two main forms: the loan estimate, LE, and the closing disclosure, CD.
Two forms instead of four or more before TRIDE, right?
Exactly. The goal was to make the information clearer, easier to understand for consumers, and crucially, easier to compare, helping to prevent those surprises at the closing table. But here's a crucial detail you must remember for the exam. TRIDE rules, and therefore the LE and CD forms, do not apply to all loans. Specifically, they do not apply to HELOCs, home equity lines of credit, or to reverse mortgages.
No TRIDE for HELOCs or reverse mortgages. They still use older disclosure forms.
Essentially, yes. They have their own specific disclosure requirements separate from TRIDE. That's a common exception they test you on. So, focusing back on TRIDE loans, let's quickly recap the LE and CD.
Sounds good. The loan estimate.
The loan estimate, LE, provides an estimate of the credit terms and closing costs. It's that initial snapshot, key points to lock in. It must be delivered within 3 business days in a completed application, using that general business day definition, creditor open for business.
3 general business days for the LE estimate.
And here's another critical TRIDE rule tied to the LE, definitely a perfect score point. A lender cannot charge any fee before the consumer receives the LE and indicates their intent to proceed with the loan, with one single exception.
Only one fee allowed before intent to proceed. Which one?
The only exception is for a bona fide and reasonable credit report fee. That's it. They can't charge for an appraisal, application fee, anything else until the borrower gets the LE and says, yes, I want to move forward.
Only the credit report fee up front. That's a big consumer protection. Okay, then the closing disclosure.
The closing disclosure, CD, provides the final terms and actual costs of the loan. This is the document you compare against the LE. Key points. It must be received by the consumer at least 3 business days prior to consummation using that specific business day definition. Saturdays count. That 3-day review period is mandatory.
Final numbers on the CD. 3 specific business days before closing to review. Got it. Now, this next part seems critical for TRID and the exam. The tolerances. How much can the actual costs on the CD differ from the estimates on the LE? This prevents that bait and switch on fees, right?
Exactly. The tolerance for fee variances is a cornerstone of TRIDE's consumer protection. It sets strict limits on how much certain closing costs can increase from the LE to the CD. You absolutely need to know these 3 tolerance categories cold and the types of fees that fall into each. This is huge for the exam.
Okay, 3 categories. What's the first one?
First is zero tolerance. These are charges that cannot increase at all between the LE and the CD. If they do increase, the lender generally has to eat the cost difference.
Cannot increase at all. What kinds of fees are these?
This category includes the creditor's or mortgage broker's charges for their own services, like the origination fee, fees for third-party services that the consumer cannot shop for. If the lender requires you to use their chosen appraiser, their chosen credit report provider, etc., those fees have zero tolerance. The lender picked them, they guarantee the estimate. Transfer taxes. These are set by the government, so the estimate should be exact.
Okay, lender fees, required third-party fees you can't shop for, and transfer taxes equals zero tolerance. What's the next level?
Second is 10% cumulative tolerance. For fees in this category, the total sum of the charges on the CD cannot exceed the total sum of the estimates for those same charges on the LE by more than 10%. It's at a 10% tolerance per fee, but on the combined total of all fees in this bucket.
Okay, a 10% cap on the total increase for this group of fees. What's included here?
This category includes recording fees charged by the county to record the deed and mortgage, fees for required third-party services that the consumer is permitted to shop for, but only if the consumer chooses a provider from the lender's written list of providers. Think title services, pest inspection, survey fees. If the lender gives you a list and you pick from it, those fees fall into this 10% cumulative bucket.
Recording fees and services you can shop for from the lender's list. Those have a 10% aggregate tolerance. Makes sense. What's the last category?
The third category is unlimited tolerance, sometimes called no limit. These are charges that can increase without limit between the LE and the CD. There's no percentage cap.
No limit on increases. Why? What falls into this category?
These are generally costs that the consumer controls. Costs the lender doesn't control, or costs that can change based on the consumer's choices or market fluctuations. This includes prepaid interest, depends on the exact closing date. Property insurance premiums, the borrower chooses the policy and provider. Amounts placed into escrow to pay property taxes and insurance, depends on individual tax bills and insurance policies. And importantly, fees for third-party services that the consumer is permitted to shop for, where the consumer chooses a provider not on the lender's list. If you ignore the lender's list and pick your own title company, for example, that fee has no tolerance limit because the lender didn't control your choice.
Prepaid interest, insurance premiums, escrow amounts, and fees for services where you picked your own provider off list. Those can change without limit. Wow. Understanding these three tolerance buckets, 0, 10% cumulative, and unlimited, and exactly which fees go where seems absolutely crucial.
It is fundamental to TRIDE and a guaranteed area for exam questions. You need to know those categories and examples inside and out for your perfect score. It's how TRIDE ensures those closing cost estimates are meaningful.
Okay, we've covered a ton of rules, timelines, disclosures. So finally, what happens if lenders or loan originators don't follow these TILA rules? The consequences have to be pretty serious, right? Understanding the penalties really highlights why getting every detail right is so important.
That's exactly right. TILA isn't just suggestions, it has real teeth. The penalties for noncompliance are significant, which definitely underscores why meticulous adherence is necessary. Knowing these penalties also helps solidify the importance of the rules, and yes, they can show up on the exam.
So what kind of penalties are we talking about? Are there criminal charges?
There can be, yes. For criminal penalties, if a violation is found to be willful and knowing, meaning it was done intentionally or with reckless disregard for the law, it can lead to fines up to $5,000 and/or 1 year in prison.
$5,000 fine or a year in prison for intentional violations. That's serious. That's a number to remember.
Definitely remember that $5,000 figure for criminal penalties. Then there are civil penalties, which are more common for errors or violations that might not rise to the level of willful and knowing.
Okay, what are the civil penalties?
For violations related to closed-end loans secured by a dwelling, which covers most mortgages, the monetary penalty range you need to commit to memory is no less than $400 and no more than $4,000 per violation.
$400 to $4,000 per violation for civil penalties on mortgage loans. Got that range.
Right. And beyond those statutory penalties, a borrower could also sue for their actual damages caused by the violation, plus potentially court costs and attorney's fees, so the financial repercussions can add up quickly.
Absolutely. It really reinforces that paying attention to every detail of TILA compliance isn't just about passing an exam or avoiding errors. It's about avoiding very significant legal and financial consequences for both the individual MLO and the company. It really brings home why mastering these rules for that perfect scores is so critical in the real world, too.
Precisely. The stakes are high. Hashtag outro. And that brings us to the end of this really intensive deep dive into the Truth in Lending Act. We've dissected the core concepts, navigated the timelines, explored rescission and advertising, tackled HOPA and HPML, and unpacked TRIDE tolerances and penalties. You should now have that precise technical knowledge needed to really aim for that perfect 100 on the TILA section of your SAFE exam.
Absolutely. As your NMLS trainer, I really want you to focus on recalling those specifics we hammered home. Remember, the two distinct definitions of business day and when each applies. Lock in those specific percentage triggers for high cost and higher price mortgages, the 6.5%, the 1.5%, 2.5%, 3.5%, and master those TRIDE tolerance categories 0, 10% cumulative, unlimited, and which fees fall into each.
For that perfect score, practice is key. Quiz yourself on those numbers, the conditions, the exceptions. Don't just understand the concepts. Memorize the details. That's what separates the top scorers. This isn't just theory. It's the granular knowledge that makes the difference. Now, as you continue preparing for your exam and maybe think about the future of this industry, here's something to ponder. How might the rapid advance of financial technology, things like AI doing underwriting or near-instant online mortgage approvals, how might that challenge TILA's current structure of disclosures and mandatory waiting periods in the years ahead? What new key points for memorization might future MLOs need to know for their SAFE exams as technology evolves?
That's a really interesting thought. How do century-old consumer protection principles adapt to 21st century technology? Definitely something to think about. But for now, you've got the knowledge on current TILA rules. Go apply it. Review these points and absolutely ace that exam. We know you can get that perfect 100.